Mhm. Good evening, everyone. I'm not sure if you're all in New York or elsewhere, so I will just say hello.
I think yes, most of us.
Or in
Uh,
New York? Okay.
exactly. Most of us are actually around Rochester. So
Oh,
welcome,
nice.
Len. It's actually our pleasure to have you in this inaugural seminar. Actually, kind of the first one that we do. So hopefully that will be the start of many more to come. So I've known the speaker for a long time now. We been worked together for a couple of years at Fisher, and then she left us. Her space is still there if she wants to come back anytime, but then I don't promise. I don't control things. Um, so I'm gonna give you just a quick overview about the introduction and the plan for tonight, and then Len will take it from there. So Len Kick is actually a seasoned tax principal with over 20 years of experience in accounting and in federal tax. She has worked in academia, and she also worked in uh, the industry for a long time. She has worked so much to spread the word and introduce people to understand more about the taxes. If you are interested to know more about her work, I advise you actually to join LinkedIn. She's always active, sending all the stuff that we need to learn about how the federal taxes will change with the new regulation related to clean energy and credit incentives and all of that stuff. So we're happy to have you here. She's also a Forbes tax contributor, and she has testified as an expert in front of the committee of the House for as an expert for that small business initiative as well. So the plan is Linda's gonna give us an overview of what exactly is the federal tax return process. So if you are a newbie and you don't know anything about taxes, this is the right place to be. And moving forward, we're gonna keep the question toward the end. But if you feel like there is a pressing question that you don't want to miss, please feel free to open your mic and just ask a question. So welcome, Lynn, and we're following your steps here.
Thank you, Mohammed. I would just say, yeah, I'm very interested in questions. So if you have one, please let me know. I would also say Mohammed was too nice on my introduction, but I had the blessing of meeting Mohammed when I worked with him at St. John Fisher University. We're very lucky to have him and now his wife, although I don't know if I can say it publicly, but working at St. John Fisher University and helping our community. We're super fortunate. So I kind of pegged this presentation to be very introductory. But if you're like, Lynn, I know this and I have a specific question, I think I could handle that too, potentially. So let's make sure we're working together. Oh, yeah. So someone said, would you let us and explain if there are new tax law or changes this year that would affect our taxes? So that the first question I'll say is everything I'm going to present to you today is based on when you file your 2024 tax return. We are expecting a lot of 2025 movement and potentially federal tax reform. And I can talk about that more, but that wouldn't necessarily apply at the earliest until your 2025 tax year, so the year you're currently in, or potentially 2026. And we can talk about that at the end after we kind of focus on what's going on right now. So email address, phone number, love working with a variety of people. I learn more from you than you probably learn from me. So definitely reach out if you have any questions. But this is again just I think I can give a brief update or training today. That's just saying I'm qualified. So you're not talking to somebody who's never been in this space before. So the first thing I think we're going to talk about is like as an individual, what is my responsibility for filing in the U.S. And then the second piece we're going to talk about is what if I own a trader business, and I'm going to talk to you about common trader business expenses and different ways that you might be able to increase expenses to pay less tax. So hopefully everyone's seeing my slides. We're to the point of who needs to file a Form 1040. So a Form 1040 is an individual income tax return for the federal government. So we're not talking about states necessarily on this particular webcast, but I will refer to it. But we're saying at the federal level, what do we need to file? So who files a 1040 is obviously a U.S. citizen, but also an immigrant who obtains green card status. And so essentially what they say is if you are either of those, Green card status, they say you verify by a permanent resident card, Form I-551. Then you are filing a 1040, Form 1040, and you're essentially looking at your worldwide income. So to the extent that you're in the US and you're making income, but to the extent you might have investments abroad, that would also be wrapped in to your 1040 individual income tax return. There's something, I'm going to assume that we don't have a lot of worldwide investments abroad, but there are mechanisms within the tax code that say if you pay tax abroad, you potentially shouldn't be fully taxed in the US on that foreign income, but you should receive something called a foreign tax credit. Someone said, what records should we keep and for how long in relation to tax filings? Would these records be needed for naturalization? So I don't know the second question, so I apologize. I don't know if they're needed for naturalization, but I will say for the first, normally when you file a tax return for federal purposes, if you're a green card holder or U.S. citizen, the normal statute of limitations that the IRS has the right to come back and audit you is 3 years from the time in which you file. So for example, in the 2024 taxable year, you might say, I'm going to be really diligent. I'm not going to go after any extensions. And I'm going to file by April 15th, meaning this upcoming April. And essentially what the IRS will say is, okay, if you filed by April 15th, 2025, we have the right 3 years from now. So I think that kicks us out to 2018. That essentially, 2025 plus 3 years is 2028. Essentially, what they're going to say is we have the right to come and audit you. And so, to the extent they do, that's when you'd want all those filings. I'll tell you, at our firm, we hold and retain all filings or information regarding our federal tax returns for our clients for 6 years. So I would, that's just a blanket recommendation. But at least for 3 years, you want to make sure you have that information. Why I say 6 is sometimes, depending on what the IRS could find, they could extend that statute of limitations. But general rule is 3. So the other thing I would like to point out, and I'll talk more about today towards the end of the discussion, is that really what they say is if you're a U.S. citizen or a green card holder filing Form 1040, you don't need to file if your gross income is less than a certain amount. So I'm going to focus in on married filing jointly. If you're under 65, that's 29,200. If you're over 65, you're in the $30,000 to $33,000 range. Why I bring this up is a lot of people will look at the slide and say, okay, well, then I'm just not going to file if I don't meet these gross income requirements. And I caution you because you should be filing if there was any federal withholding tax, which we get into later. But if any type of entity that you worked for or potentially Social Security benefits or anything, maybe even withholdings on investments, to the extent that the federal government got some of your withholdings and your income levels are within this genre, you're probably going to want to say, I'm going to file a tax return, not because I owe any tax liability, but because I actually don't owe any. And so all those withholding taxes that were paid on my behalf to the federal government should come back to me in a refund. And we'll talk about some other important things that come up when we're in kind of this space. And then you might be on the other side and say, well, Lynn, I'm not a green card holder. I'm not a US citizen. And you might say, do I still need to file? And that's when I start talking about a form called the Form 1040 NA or 1040 non-resident. And essentially, a non-resident alien is someone who doesn't have a green card and doesn't meet the substantial presence test. So I'm going to, at a very high level, try to explain what the substantial presence test is to you. But essentially, what the IRS says or the tax law says is if you spend a significant time of your time in the U.S., then you meet the substantial presence test and you need to file something called a 1040 that we talked about previously instead of the 1040 NR. And so essentially what they're saying here is we're going to ask you to, the first question they're going to ask is, for example, in the 2024 taxable year, were you in the U.S. for at least 31 days? And so if you hit that box, that does not mean you're automatically filing a 1040. You have more tests, so it's an and test. And the second test says, okay, if you're here for at least 31 days in 2024, because that's the tax year we're considering filing right now, right? That's due on April 15th. We then ask ourselves, well, during the prior 3-year period, so that would be in 2023, 2022, and 2021, did we exceed 183 days in the US? And essentially, I would look at all the days I was present in the current year, right? So again, we're talking about the 2024 taxable year. You say, yeah, I was here 100 days. So you obviously checked the first test. You were here at least 31 days. And then the second test is, okay, do I get to 183? And so they say, okay, 100 days. Now you're down to, was I here 83 days? And in the previous year or two previous years. And there's like a calculation test. Essentially, you don't get hurt for a day for day transaction. They say we won't count it as a full day towards the 183 days unless you physically have been here 3 days for the prior year, and 2 prior years you have to be there 6 days. So essentially, they're still weighting your activity in the 3 year period, but it's weighted in the two previous years and the previous year. So if that did not make sense to you and you need additional help, I have a great example that I'm happy to share with you. But so even to the extent you say, I'm not a green card holder, I don't meet the substantial presence test, and I'm not a US citizen, you still very well could have to file what we call a 1040 NR. The 1040 NR is interesting because it's not based on our worldwide income anymore. They don't care if you have investments abroad that you're incurring income from, or you work 3 months out of the years in a foreign country and then you come to the US. If you file a 1040 NR, we're only concerned about income that's sourced in the US, and that source word can be a really broad topic depending on what we're talking about. But essentially, if you work in the US, they're only going to tax your US funds under the 1040 NR. The US doesn't stretch their hand to say, I'm going to look to other countries to bring in that income. So that's another one you should be aware of that you might potentially have to file. Other things I'd like to point out is if you're here as a student, teacher, or trainee, there are specific exceptions for those types of non-resident aliens. And so essentially what they say is they talk about and the F, the J, the M, or the Q visa. They're saying you are considered engaged in a trade or business in the United States, but you don't have to file that 1040 NR. Only if you have things like wages, tips, taxable scholarships and fellowship grants or dividends. So essentially, if you are told or you are provided confirmation that you're here as a student and you received a scholarship, and that scholarship is not taxable, meaning that they are saying it's completely tax exempt, then you would not have to file the 1040 NR. But to the extent you work and get a wage, or to the extent some of your scholarship is taxable, or you have dividends or other types of income, now you're required to file the 1040 NR. I provided, so anything you see in blue is hyperlinked. So I provided some websites throughout the IRS that you can go to for further information. Okay. The 1040 NR is really quite in depth as who needs to file. I'm not going to go through all of these, but essentially there's a variety of different ways that you could fall under the 1040 NR. I'm going to say simplistically for our purpose, if you are not a citizen or a green card holder and don't meet that physical presence test, then we're only going to say you have to file the 1040 NR if you generate income in the US. We just discovered this. This is different than what we just talked about when we talked about filing the 1040. We said if you file a 1040 and are a citizen or a green card holder, you have to meet certain taxable income requirements. And so if you don't, you're not required. However, for a 1040 NR, even if I only get paid $200 from the US, or I have a taxable scholarship, or I worked on campus and it's taxable, then you automatically have to file that 1040 NR. There is no minimal taxable income limitation like there is under the 1040. So that's where we're kind of ending up. Again, I'm monitoring questions, so thank you for everyone who's chatted. Other thing that you're probably aware of is you just want to make sure the identification number they're using on you is the same identification number that's being used to report to the Internal Revenue Service. So for example, there was in the past where my husband or I were issued a W-2 and they had the wrong EIN number on it. That's an issue, right? Because now the IRS is saying this EIN, was paid X dollars and they're not reporting in right to the IRS. There's a matching principle that's not matching. So I just remind you that it is important to check to make sure they're using your appropriate Social Security number. If you don't have a Social Security number, that they're using your ITIN. And if you don't have an ITIN but need to essentially obtain one, because you will need to file a 1040 or a 1040 NR. I just caution you, it takes about 7 weeks to get that. So that would be something you would want to start doing now as opposed to later. Okay. Okay, so I have a great RIT alumni. I'm just going to say it's easier for me. When is it better to use tax software to file taxes versus hiring a professional tax preparer? So I'm going to walk you through this actually today, and I'm going to say if all you have is a W-2, we're going to say not only I believe you can do it yourself, and I will take questions, but they're also, depending on your income threshold, I can get you to file it free through the IRS. So the thing I don't necessarily like about some of those software companies that advertise during the Super Bowl, like TurboTax and all that stuff, is sometimes their fees can get quite ordinate. So you're like you're paying $300 for a very simplistic return. The IRS actually has people that will help you, and that it will be free. I would say when you probably will need to use a tax preparer is if you are indeed being taxed on your worldwide income and you have significant income abroad and you're trying to utilize foreign tax credits. That can be a bit trickier. And that's where I would say you probably would want to go that way. I would say even if you're daring enough, if you have a W-2 income and you run a small business or you rent a building, you can probably work through it. But at that point, I probably would direct you to like a TurboTax or something like that. So it really is facts and circumstances dependent. W-2, I think you can do on your own. W-2 plus rental income or a self-employment, a small business that you own. I think you can do it with TurboTax or some similar software. And then to the extent you're going after foreign tax credits, I think that's when you really need to bring in, and I would say significant foreign tax credits, not, but you would probably need to bring in another person. Are there any tax credits or incentives for first-time home buyers that I should be aware of? We'll get to the credit portion. Unfortunately, at this time, there is not. It was a big debate. If you focused on the presidential elections, Vice President Kamala Harris was very proponent of providing some type of benefit, and they were quite significant. President Trump, not as much, but later in the election period, he touted that he might. As far as I'm aware of at this point, I don't see that any discussion regarding 2025 federal tax reform. If you're who needs to be filed for an F status? What's an F status, Mohammed? Do you know what an F status is? That
I'm assuming that they're talking about the visa. Yeah, student
visa.
Yeah.
So I'm going back. So if you're an F status and and you're sole owner of an LLC, you would still have to file a 1040 NR for that income that you're making. Because essentially what they say is the only time that an F status wouldn't have to file a 1040 NR is essentially if you were saying, I only am a student or teacher or trainee, and all the income I'm receiving in the US is tax exempt because it's scholarship and not taxable. If you have your own single member LLC, we'll talk about in a little bit, you have your own business, and you're going to report it on your 1040 NR and report that income in the US to pay tax with. Okay, I'm going to keep. Oh, someone. Wow, I did that. Yeah. Do I need to report earnings from crypto on my tax form? I will get to that at the end if I can, but that's a complicated one. And it's
We're a
only
complicated audience, so they expect the best out of us.
so it's only going to get more fun as we talk about that. Yes, I will talk to you towards at the end. It's really heating up, and we expect it to heat up even more with the new SEC appointment. Okay, so we talked about this. So this is an income tax formula, and I don't want to get. We're not going to get too much into this, but from a 10,000 foot view, I'm going to bring up the 1040 for y'all, and you'll see like we start with gross income. We talk about some deductions that you may be able to receive. Then you go into adjusted gross income. Then we're going to take a standard deduction or itemized deduction. And then we're going to potentially look at a qualified business income deduction. This is called a 199A deduction. If the person on the phone says, I have a Schedule C, this is a big deduction for you potentially. If you're not doing consulting, it depends on what your activity is. But the qualified business income deduction, they'll say instead of taxing you on 100, they're going to give you a 20% fictitious deduction. So they're only going to tax you on 80. So it's very specific of what type of businesses can fall into that, but it might be useful. Ultimately, we get to taxable income, and then we apply our tax rates, and then we owe a certain liability, and then we apply if we've paid in or not, whether or not we owe taxes or a refund. So this is a 1040. I'm just sorry, I'm reading more questions. Sorry, could any new rules? Yeah, we'll get to we'll get to the potential changes in the future. This is a 1040. So at the front, that's why I'm saying if you only have W-2 income, your W-2 box 1 is literally going to go on line 1A. Okay. The only other item that sometimes if you're in the service industry and you're working, you might have tip income. And so there's something called self-reported tips. And then there might be a tip calculation that your business is doing on your behalf. But essentially, those are different types of income items. Again, income items would be interest, dividends, Social Security income. Those are all types of income that would have to be included on your page 1 of your 1040. And then capital gains and losses. So again, just think really what they determine income to be in the US for tax purposes is, did you receive economic benefit? And when I used to teach, I used to always say, if you find $100 on the street and you pick it up and you put it in your pocket, should you declare that on your tax return? So obviously you should, right? It is an economic beneficial benefit, but will you in reality? That is neither. I would, because I'm a CPA, but I'm not. So I'm just saying in general, if you get economic benefit, the IRS is looking to tax that. So here's something that you might be receiving. It's called a W-2 form. A W-2 form is from your employer if you're in an employee and employer relationship. So for example, I work for Witham. I'm an employee of Witham. So that's who's sending me my W-2 form at the end of the taxable year. So here's where I'm going to highlight a couple things. So on this W-2 form, they're quite standard. You should see your Social Security number or your taxpayer identification number, and that's what you want to make sure matches, right? So the IRS is getting the same information that you're reporting. Then this employer identification number, in my example, would be Witham's, right? The person who's giving me the W-2 has to give their employer identification number, and this is their address. Here's where you want to cross-check and say, do they have my name correct? Do they have my location correctly? If you move during the year, I wouldn't be too nervous about it being the old location versus the new, but definitely want the name to be correct. So then, just like we previously just talked, when I box 1 wages, here they would have to report 47,000. And that's where that 47,000 would come in on the 1040 for the W-2. Some of you might sit there and say, why is this 47,000, but Social Security wages is 50,000? And the reason for that is there's a variety of different things that an employee can engage in that would be taxable for Social Security purposes, but wouldn't be taxable for under box 1. So one of those items might be dependent care, right? If you essentially a portion, I think it's up to $5,000 now because you have kids and you're paying for daycare. That $5,000 wouldn't be included in box 1, but it indeed would be included in box 3. So box 1 flows directly to your page 1. The other big item I like to point out is, and this is what I was saying before, your federal income tax withheld is in box 2. If that's greater than 0, even though you might not be required to file a federal tax return, you probably want to, because that's going to be essentially refunded to you. So for example, in this example, if I said, oh, I'm under the required limit and I didn't file a tax return, the federal government gets to keep that $4,700. The only way I get it back is if I file the tax return and say, I paid you $4,700. And when you actually look at my income, I don't owe you anything, right? Or I owe you less than that. So that's an important one to know about. And then we talked about tips. Again, at service industry, Social Security tips and allocated tips, 7 and 8 are going to be where those tips that you declare. Allocated tips might be tips that you didn't declare, but were calculated based on a methodology of your workplace. But those would also potentially be taxable and brought in. And don't get nervous if they're all brought into box 1A or they're brought into box 1A and 1C. Just as long as they're reported is the main point. The other item that is really important on your W-2 is it's going to say what state you did your work in. So in this particular one, PA means Pennsylvania, and Y would be New York. It's going to have, again, how much were you paid? And again, for federal purposes, you tax 47,000, but for state, you tax 50 because 50 doesn't respect the dependent care set aside. And then this also shows that you were withheld $1,535 for purposes of Pennsylvania. So similar to the federal return, if I don't owe that and I don't file, I don't get it back. So we often encourage people, to test that out to make sure you're not leaving any money on the table for purposes of your state or your federal.
Then I have a question here about
Yeah.
the different states. So if somebody moved from one state to another, that becomes a little bit complicated. So let's talk about New York specifically. If
Mhm.
you worked in Texas, for example, and then came here in August, uh, where would you file that, and how things should work? Based on two different states.
Yeah. So they're going to talk, there's something called, for state income tax purposes, a residency test. And so, for example, I'm just going to say New York. New York, we pay income tax, we pay a fair amount. And so I have clients who say, I'm going to sell my business and create a large transaction of income, and I don't want to be taxed in New York. So I'm going to create my residency in Florida. To create residency, it's very similar to the federal test that we just talked about. You have to be in that state for greater than, I think it's 181 days. So essentially, in your example, if I'm in another state for 181 days, I'm going to be pulling in my worldwide income, which would include all my federal income, right, to that state. And then in New York, what's going to happen is New York is going to say, okay, you weren't a resident of New York State this year because you weren't there for 183 plus days, but we're still going to tax your New York sourced income. What I would caution everybody, or really tell you to, then this is where you probably want a tax professional to be a part of, is any tax you paid in that other state might be able to be utilized in New York to offset your New York tax liability. Meaning the federal government and the state governments are of the understanding that we shouldn't be taxing the same dollar twice. So remember, in my first state that I'm a resident, I'm paying tax on all of my income for the year, no matter where it was earned in the United States. In my second state, I'm only getting taxed on New York income. And so essentially, if that New York income was already taxed in the original state, I should get a credit for state taxes I paid in that state. That's what you should happen. Not every state operates the same, which is why state income taxes can be complicated. But that's definitely a great question that you might have to file actually in two states. But in reality, you can only be a resident in one state for the year. Does that answer your question, Mohammed?
It did, as always. Thank you.
Okay, perfect. So then other forms, I would just tell you, you might receive a 1099 div statement, which is going to be telling you what dividends you might have earned this year. I do want to point out, because a lot of people miss this, you want qualified dividends, right? Qualified dividends generally are taxed at a lower rate, right? They're going to be taxed at what we would call our long-term cap gain rate. So that could be 0, 15, or 20%, versus total ordinary dividends are taxed at your marginal, which could go all the way up to 37%. So you really want to make sure that these are being reported properly. The ordinary dividend amount will include all dividends. So let's just give an example and say I have $100 of ordinary dividends and 20 of those ordinary dividends are qualified dividends. $100 will go on line 3 here, 3B, and $20 will go under the qualified dividend line. You might say, well, what's the benefit? Well, when the system calculates your tax, the $20 is going to be taxed at lower rates of dividend income, and the remaining $80 will be taxed at those higher rates. So we really want to make sure we're deciphering between ordinary and qualified dividend income. Okay, I'm going to just go through some of the questions here. Are there any tips for maximizing tax benefits through retirement contributions? Absolutely. So every year they come out with a maximum contribution amount. If you're above 65 or you're below 65. And I am not a financial advisor, so you should definitely contact your financial advisor for this. But so I would say a couple things. One, if I'm contributing to a Roth IRA, I'm going to try to maximize that Roth IRA, which means a Roth IRA is money you're putting into an investment, an individual retirement account that's already been taxed. But that means the growth after that Roth IRA is not taxable. meaning that I can repull from that in 30 years from now, and I'm not going to be taxed on that amount. An IRA is different, right? An IRA is the one that you're going to say, I'm not taxed on it now, so it's actually going to create a deduction for me on my 1040. But when I eventually take it out in 30 years, the interest, the dividends, they're going to be taxable. And so what you find for most financial planners is they're very much of the course of, we want a mix of that when you retire. We want some that's taxable, right? Because we're not going to give away the fact that we can get some taxable income here allocated at a very low rate, but we want others non-taxable. So I'd also say maxing out your 401k plan with matching. There's a bunch of different ways that you can take advantage of retirement planning. Okay. Some people are saying, how are transactions from platforms like Zella, PayPal, and Venmo treated for tax purposes? Does the IRS view transactions? Oh, this is a good question. Sorry, I'm getting there. Such as friends and family versus goods and services differently. Absolutely. So they've really buttoned down on this over the last few years that they want reporting to come out of these Zella, PayPal, and Venmo accounts. If you've ever been on Venmo or PayPal and you're transferring money, like maybe I'm transferring money to Mohammed because he bought me lunch, that shouldn't be taxable event. You should get a prompt on your transfer that says, was this a payment for services? And that really means, are you paying, in my example, am I paying Mohammed because he provided a service for me, right? He reviewed my investment account, right? So then I would say, Mohammed would, if I pick that button to be yes, then indeed Mohammed should be declaring that on his tax return. And you should receive some type of form that substantiates that. Alternatively, if I pay Mohammed and it's just for a reimbursement of lunch, hopefully the person didn't pick that was for services, and that should not be taxable on your tax return. The problem is most people have no idea why they're pressing that button, right? They don't understand that if I'm saying I'm giving a Zella payment and I say, yeah, it's for services, well, it's automatically deemed taxable at that point, even though it might have just been for reimbursement of a lunch. Like, not a lot of people understand why that question is there. So hopefully I answered that question. So before we move on, and we're going to get to Schedule C or single member LLCs and rental income in a second, I think other income items that you're sitting there saying, I have this, is this taxable? There is something on here that talks about, I don't know, if Schedule 1, line 10. So that's additional income. And there's various things that might create additional income. One of them could be employment compensation, because if you remember, that is taxable at the federal level. So if you're saying, I don't necessarily know how I fit in through 1 through 6, through 7, it's something different. You can go to Schedule 1, line 10 and look at those items that essentially say different items that could be taxable. For my friend talking about cryptocurrency, you're most likely going to have to, and we'll talk about it in a second, but you're most likely going to have a Schedule D transaction, which is essentially is saying, I'm giving up my, or I'm paying my, I'm giving up digital, I'm buying digital currency for X and then I'm selling it for Y. They view that almost like a stock transaction. So if I'm buying stock for $20 and then I sell it for 30, that appreciation needs to be taxed. Similar with crypto currency. Okay. Okay. So once we get to our adjusted gross income, so we just looked at all of our income, we really want to focus on a standard deduction or itemized deduction. If you're filing a 1040 NR, there is no such thing as a standard deduction. You only have an itemized deduction. But if you're filing a 1040, then you can choose the largest deduction amount. And I think what is confusing for many is that this standard deduction, all you have to be doing is breathing to receive it. Like, they're not looking at your home mortgage interest. They're not looking at anything you do other than saying, okay, if you're married filing jointly and you've reported all your income, you automatically can deduct $29,200 for the 2024 taxable year. It's a standard deduction. The standard deduction does vary based on your filing status. So married filing jointly, you don't need kids, right? You could just be married. And essentially it's saying, we're married, we're not under a separation decree, we're not divorced. And that deduction would be $29,200. A qualifying surviving spouse. So if you're, this is a hard one if you've been it, but we've had a couple of people who qualify for this. Their spouse has died in the last 2 years. And so essentially what the IRS says is, if the spouse hadn't died, you would be married and we would have given you 29,200. They extend that for 2 years after the date of death, provided you were still married at the date of death. So if that's your case, unfortunately, there is a little bit of benefit for the federal income tax purposes. Head of household's a big one. Single mom, single dad, and you have a child in your household. This head of household one is often overlooked. But so if you're not married and you're single and you're raising children, and you provide their support, that's the most common example of head of household. And so that's obviously a higher deduction that you would be receiving as opposed to if you were just single. So single, they define as you're not married filing jointly, you're not a surviving spouse, and you're not a head of household, then you're single. So definitely, if you're not married but you have children, you might dig a little further to see if you can get a bigger deduction under the standard deduction. Again, you're just breathing, right? They're just giving you this deduction. An itemized deduction is different in the fact that you have to have paid things to be able to get an itemized deduction. So one is state and local income tax. So that includes real estate taxes, school and county taxes, which probably gets a lot of people excited on this phone if you live in New York because they're very high. That's the whole debate right now. The debate is by 2018, they said you can gather all those taxes together and you might have 30 or 40,000. You're only taking a $10,000 deduction on your Schedule A. They're capping it. They're saying the maximum amount is $10,000. And that is a big discussion in tax reform in 2025. And then home mortgage interest, if you have a principal balance of $750,000, then you might have mortgage interest that you're paying on that generally is deductible. It could be higher principal balance depending on the time in which you bought your house. And then charitable contributions. So what we found is as of 2018, these numbers, the standard deduction has gotten much higher. And the fact that they capped that $10,000 SALT deduction has made it, I think it's up to I want to say it's as high as 94% of people filing in the United States are taking the standard deduction. It just that the Schedule A, they're not getting there because of the tax SALT cap on the 10,000. But again, if you have large charitable contributions in a year, that would pop you over the standard deduction, and that's another financial planning technique that you can work through. You can give all your charitable contributions to a donor advised fund in 1 year and wrap that number up so you get some tax benefit. And then essentially in the following years, you'll distribute that. But at least in that 1 year, that's deemed the time in which you made the charitable contribution for itemized deduction purposes. So again, something to watch for if you're anticipating, or if you're a regular giver and you're right at that point, you might just say, I'm just going to give the next 2 years on December 31st, and then I'm going to get at least some tax advantage for it.
I don't think we have a Tom Galasano in our audience, but hopefully someday we'll have somebody who's able to do that kind of donations. But I would like to remind everybody that we also accept donations for
Oh
our
yeah.
organization, so to make sure that we are able to run our program smoothly. So I appreciate your contribution. I just wanted to, tie it to this very important piece that contribution actually helps for tax deduction.
Well, and the one thing, I don't think it was there. I don't think it's there anymore, but you might see it come up again depending on where we go. When you're on the 1040, you'll see other deductions here. It's under here. I'm sorry, maybe I cut it off, but there's an other deductions line right here. Adjustments to income from Schedule 1, line 26. Even if they were allowing at one point, if you gave cash contributions of up to $250, for that $250 to be deductible, meaning you were getting benefit for charitable contributions, even if you weren't filing a Schedule A. So if you do give charitable contributions, but you're still not getting over that hump on Schedule A, go check out that line 10 and see if you might be able to at least deduct $250. Yeah, no Tom Golisano's on my side either for me. Okay, so any questions so far? I think we're caught up on the question and answer. We're going to go now to a little bit about, okay, well, I own my own business. So somebody said I have a single member LLC. How do I report that? Or you might have a rental property where you own the property, but you're collecting rents. We're going to focus on Schedule C. The one thing I would say about a Schedule C is you're saying I'm in a trader business. So an activity engaged in for profit with continuity and regularity does not mean you need to be doing it every day. But really, what they're trying to decipher from here is a trader business versus a hobby, right? So I buy a horse, I sell a horse 3 years later. That's a hobby, right? And that's not a trader business. So really trying to make sure, and how you get deductions for a hobby is much different than how you get deductions for a trader business. So that's really the intention about, is it a trader business? What's included in gross income? So if you sell to customers, obviously that's included in gross income. But the other thing you might find yourself, which is kind of unique, is you might say, well, Lynn, I don't get a W 2 from my employer. I get this thing called a 1099 miscellaneous. And what a 1099 miscellaneous says is essentially you're not an employee of the company you work for. You're what they call an independent contractor. And an independent contractor doesn't report their income on box one of the 1040. They have to report it on a Schedule C. And so essentially, if I consulted for a company in town for maybe 4 to 6 weeks and they paid me as a contractor, I'm automatically going to be reporting that on Schedule C. And the trigger to know whether you're an employee or an independent contractor is what form do they issue you, a 1099 miscellaneous or a W 2. So this is a Schedule C. I'm going to point out 99.9% of people, when they file their Schedule C, they're going to be cash basis. So cash basis is essentially a individual concept for U.S. federal income taxes, which means I, Lynn, the individual, I don't recognize income until it's in my bank account, and I don't recognize expenses until it's out of my bank account. And so essentially, under the Schedule C, I would be performing the same methodology. So meaning if you did services for someone at the end of 2024, but they didn't actually pay you until 2025, that income is not reported on your Schedule C for the 2024 taxable year. It's bumped to the year in which you actually receive it. You're going to essentially, again, report gross receipts or sales. If you're manufacturing something, you could have cost of goods sold, and then you might have other income, not as common, but essentially you're saying for my business, what is all the income that I brought in this year? That's pretty. And so someone had mentioned, what if I get paid through, PayPal or something else? That's where this, and it's a Schedule C, you're operating a trader business. That's where that income's going to go. The other big piece of this is after you report all that income, you don't want that to be your taxable income. You want deductions, right? To be lowering that income. And so what's a deduction that we can take for trader business? It has to be ordinary, necessary, and reasonable. So ordinary, if I'm an accountant, buying a tiger is not ordinary to my trader business, has no relevance. So that would not be a suitable deduction. And I also think what is necessary, it's important to realize you don't have to prove it's essential. You just have to prove it's helpful. So maybe, for example, as a tax person, I find using Bloomberg research is very useful. And so that's not essential. Like all tax accountants don't need that, but I find it very helpful. So that would be considered necessary. Reasonable in the amount and reasonable in relation to its purpose. I would say, if you're in construction and you're using steel screws, obviously that's reasonable. If you say they have to be gold plated, not so reasonable, right? So really just, I also watch reasonableness with where we see people stretch the law here is with business trips where the family comes and it's also partially a family vacation. You can't run through your family's, trip expenses, your visit to Disney World. It really has to be the portion that's related to your business.
So just to make sure, we're talking here about just the business piece. So if I have my own expenses, and I'm actually working with W-2, in
Mhm.
that case, I'm an individual just working for X company, and I have some expenses that I incur for maybe travel or other things. Those are part of 29,000 if I'm following the more method jointly. But if I have above that, can I add these items? Like if I have 29 and more, can I add these items to be exempted?
So if I'm an
Got it.
employee in an employer relationship, I pick up my W-2 income from that box one. And if I have, normally if you now have your own personal expenses, like you bought a printer or you did, that is not going to be deductible. It's very rare it would be, but if it would be on a Schedule A. So I believe under the TCJA, they said employee expenditures they're definitely under the Schedule A, and I don't think that a significant amount are allowed. Alternatively, if you're in a single member LLC, as for example, so you want to think I'm running a business as an LLC or as lawn care or as small business where I haven't incorporated it. So I'm not a C corporation. I haven't filed articles of incorporation with the state. I'm not a partnership. I haven't, it's I who fully own it. There's no one else involved. Then essentially we would say you're a Schedule C trade or business, and then you can start looking at the deductions we're talking about.
Got it. Thank you.
Good question. So here are some common ones I'm just throwing out there. So advertising, office expenses, so printers, right? Staples, paper, pens, etc. Commission and fees, potentially contract labor. So, and they also talk about wages. So if you own your own business, but then you hire additional persons for the summer because that's the peak, or the winter because that's the peak, those would be deductible when you're trying to offset how much income you brought into the business. Insurance. So you might have to carry certain insurance, right? Obviously, bonded insurance or elsewise, depending on your activity. Interest, if you took a loan out for your business, then that's business interest, and that can be deductible here. Versus when I take a loan out for my personal use, generally that cannot be deducted as personal. We don't allow that to happen. In the very beginning, they allowed credit card interest to be deductible to help after World War II, but that's now no longer. And so it really has to be related to a trade or business to be deductible. Repairs and maintenance is important too. There's a difference between, okay, I have a piece of equipment and I'm repairing it back up to normal operation. That's not something you need, which we'll talk about in a second, to depreciate. That's something that's immediately written off, right? It's a repair and maintenance. Travel and meals, we already kind of highlighted, associated with business, totally fine. And essentially all those expenses are going to offset the income you're recording for your trade or business. What I like to point out for small businesses. So I'm now going to move into this section of you're buying an asset that's going to give you benefit outside the current year. So if I bought pens in 2024, I'm saying I'm using that right now. It's not giving me benefits outside the current year. If I buy a sewing machine, I'm just making a wheelbarrow, if I buy some type of equipment that I'm going to use this year, next year, the following year, then essentially what the IRS says is you can't fully deduct it because it's giving you value outside of the initial year and when you purchased it. So that's the general rule. Most small businesses will use something that's called 179 or an accelerated deduction. And so this was very small in the beginning, but has gotten quite large as inflation has happened. Plus, it's been on the books now for almost 20 years. So essentially what they're saying is if you go out and you buy that piece of property or that, which again, could be equipment, could be a building, whatever you're purchasing for your business. Actually, it can't be a building, but I'll go back to that. We're essentially saying it's Section 179 property. And if you fall under these limitations, then you can immediately expense it under 179. And so that's this underline 13, depreciation in Section 179 expense deduction. So in this scenario, they say I went out and I bought $200,000 worth of equipment under 179. If that's all I bought in the year, then I passed the first limitation, which says you looked at the total cost of the equipment that you bought. It didn't exceed 1,220,000 for the 2024 taxable year. Check. That's true. So I'm allowed up to that amount. Then they said, when you look at all the 179 equipment you bought, does it exceed $3 million? And I said, no, I only bought 500,000. So now I've hit the second limitation. And then the third and final limitation says, okay, then you can immediately deduct that 500,000 like we want to, right? We don't want to have to spread it over 5 years. We want to take that deduction immediately. And so we can immediately take that deduction as a 179 expense. And it applies to new and used property. So this is a really good item to keep in the back of your mind if you're buying equipment that essentially I'm going to immediately expense it, provided I'm under these limitations, which are quite large, right? They were not this large when the bill originally was enacted. So you might find we find a fair amount of small businesses are 179 their property. Why I want to say 179 is better than bonus. So I know some of you might know about bonus depreciation is for the state purposes. 179 generally is allowed. So if I take a 179 deduction for federal, New York State's going to allow it, and they're going to follow the same methodology. If I take a bonus depreciation for federal purposes, the state's going to say, we don't agree with bonus. You have to add it back, right? So you're actually raising your state income tax liability if you're choosing bonus over 179. So we say to all our clients, if you can get in your foot in the door under 179, that's ideal. And the second piece is if you can't, then we would go to bonus depreciation. People were asking about, are there tax laws changing? Absolutely. And this is a big one that's on the list of concerns. So in previous years, we've flexed from 50% to 100% of bonus depreciation. Bonus depreciation has been a long time. So as if you're reviewing, if I bought again $200,000 of equipment, the general rule would be you take and expense that over the life of the equipment. So if it's 5 years, I take 200 divided by 5, and I take that in year 1, year 2, year 3, et cetera. Essentially, what bonus depreciation says is we're going to accelerate your ability to deduct that all in the first year. So it's normally been 100. So what we've seen in the past, similar to 179 property, if they know they're fully going to get the deduction and they know it's going to wipe out their tax bill, that's a cash impact savings that might promote them, right, to go buy equipment at the end of the year, because I'd rather be paying money into my business by buying equipment than actually paying money to the federal government. This is decreasing. So it started most recently at 100%. In 2023, it dropped to 80%. In 2024, it dropped to 60%. This year, it drops to 40%. This is very concerning for a lot of people who deal with equipment. And so essentially what's being debated right now under tax reform is, will we, essentially I should add, it's ultimately going to drop to 0%. So in 2026, it will be 20%. In 2027, it's gone. So will we be able to bring back bonus depreciation? People are trying to. There is debate of whether it'd be 100% or 50%. It might not be 100%, but definitely something to keep your eye on. And then the last thing, I won't get too much into this. It's just an FYI to let you guys know. Please be aware that if you buy a car for your charter business and you use it at least greater than 50% of the time for your charter business, you very well could get capped on the amount of deduction that you're allowed. So I bring this up because it's kind of unique and odd, but be aware that there's an additional limitation if you're using a vehicle in your charter business. I have to go quickly because I know we're running out of time. This is the one I really want you to focus on. So New York is included here. And essentially, if you have income for families and individuals, this $84,000 or less, so that's your adjusted gross income for 2024, you can file free on the IRS website. Even some states are included in the free filing. They have a chat there to help you, but I really think it's worth it to explore this. Again, I said if you just have a W-2, this would be the way that I would go. This is the information you need if you're going to be filing on the IRS website for free. And so very similar to what we talked about, W-2s, you need an identification number. If you didn't file last year for federal tax return purposes, and this is your first year, you can still get through this by just putting 0 where they ask that question. And then your bank account and routing number, if you get a refund, you need to be able to tell them where to put it. And then I'm going to fly through these, but these are such low hanging fruit. And I can't tell you how many people miss them. Earn income tax credit. I would be doing you a disservice if I didn't talk about this, because every time I go to an AICPA event, we leave millions, hundreds of millions of dollars on the table every year where people don't actually claim the EITC, the earned income tax credit. Essentially what it's saying is you will receive a refund because of the fact that you're working and your income is low. So again, even if I don't have to file, this is something I would want to file for. I do need to have a Social Security number to file. These are the limits, right? So if you have children and you have one child and you're married and you're making, your income is $56,000, you qualify for this credit. One child, the qualifying credit for 2024 is up to a $4,200 pay back to you. They will physically mail you a check for $4,200. We can't get into it. There's lots of great slides in this, but please, 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 this is a great one to be aware of. And if you say, Lynn, my income's too high, that's not going to work for me. Don't forget about the child tax credit, at least for the 2024 taxable year. The child tax credit will be provided to you, and a portion of it can be refundable, meaning that the IRS would cut you a check. And this annual income is much higher. It's 400,000 if you're filing a married filing joint return. So if you have children, and this is what the children must be in general, at the end of the taxable year, they're under 17. There's all these different types of people that will be considered your children. You provide them support. Don't miss out on potentially getting a large credit of up to $1,700 refunded to you. And then the last, and but not least, again, if you have children, and you can tell I have three, this is why I keep talking about these. If you work and you're paying for childcare, which is astronomical right now, you essentially can also get a credit for that in your tax return. So they say if you're working and that you have a dependent under the age of 13, so they can't be 16 or 14, they think they can take care of themselves at that point. But essentially, they'll allow you a dependent care credit. And right now, $2,000 is the child independent care credit, and you can potentially obtain a refund of $1,700 in the 2024 and 2025 taxable year. Again, large income that can be generated, 400 or 200,000. So just a lot of good credits out there. I know we flew by that, but if you have additional questions, and then I can't reinforce, like, if you do qualify to do your taxes on this IRS free file, go for it. Some of those tax fees by TurboTax, they can be really, really expensive. And I think that's it. I think I got through everything right at 8:29 with 1 minute left.
You're doing great. You're doing great. Don't worry about the time, as long as you're not busy. So I
No.
appreciate the time here. So I have just a concluding question where I think that happens sometimes when you go over the tax and you thought that you went through everything that you can take credit for, but then you file your taxes and they come back and say, well, based on our deductions and the calculations, you owe this amount, right?
Mhm.
And then you are in that moment thinking, okay, that's too much to be paid just in taxes, and I think I can use it for a different resources. So I know that people sometimes think about the retirement account, which actually can help them
Mhm.
increase a little bit of the deductions. What are the options available for somebody who got this massive surprise, unpleasant for sure, that
Mhm.
they owe a lot of money to the IRS and they have to pay that? So what they need to think around.
So I think if you're getting a surprise bill, I would say breathe. There are plenty of, especially depending on how big the bill is, timing payment plans that you can automatically enter in with the IRS, and pay it over a period of time. I also would say it is hard to create deductions after the taxable year. So right now, if in 2025 I say, wow, my tax bill is really, really high in 2024, we talked about potentially donating to an IRA account, but if you don't have money to pay your taxes, you probably don't have money to contribute to the IRA account. So I would say there definitely are different methods in which you can.
But you have like sometimes a trade-off between like I'm gonna pay that money anyway. So should I pay it for myself versus the IRS?
Oh, yeah. I mean, definitely at the end of the year, that's where we go out. If we're equipment buying, we go out and we buy big purchases. For the IRA, you have to have it paid into the IRA before you file your tax return. So, nice thing about the IRA is that you can be putting it in your account in 2025 and relating it back to your 2024 year. Meaning, as long as I pay into my IRA prior to the time in which I file my tax return timely, then I essentially can now allocate whatever I just paid in 2025 to a 2024 deduction and lower my taxable income. But there's a lot, I would say in general, if you're not a W-2 employee and you have some flexibility around how you're recording expenditures or not, right on your Schedule C, I'm going to tell people honestly, and it's not illegal, don't, I did these services for you in December or even November, don't pay me till January. I'm going to say, I got this bill. It's not due until January 5th, but I'm going to pay it on December 29th because essentially that's going to give me more deductions. So there's a lot of things you can do at year end. After the year end hits, it becomes a little bit more complicated.
So just to for people who are not really knowing the difference between the things that related to the retirement. So we have three different things that usually people would hear about: the 401k, the Roth IRA, and the traditional IRA. So can you walk us through the difference in tax treatment for the three?
Yeah. So a 401k, remember when we talked about there's things that you can give to you get a benefit for when you're an employee in an employer relationship and it's not taxable. So for a 401k, I'm looking at my company's policy. It's a company policy. So I only get it if I'm an employee. And generally, when you get your benefits package, they'll say, okay, we will match, we will give you 3% on whatever you contribute up to a certain amount of your income, right? So, meaning now instead of me taking all the income home, every pay period, I'm going to say, I'm going to put some of that money into a 401k. And as that 401k grows, or actually as soon as it gets money, the company's matching it. So normally what you might see is a company might say, I will match a contribution up to $10,000 for 5%. So that means that you're getting $500 from your company every year free. And so generally what we say is and the contributions you're making to the 401k are not taxable at the federal level. So generally what we're saying is go for it, right? And not everyone can, but to the extent you can max that out, right? And say, I'm going to put in there whatever the company will match. So that $10,000, that's my goal, because essentially it's free money that the company's paying in, and the 10,000, if you do provide it through your W-2 through your election, it's not taxable at the federal level. So that's a win-win. That's kind of like the first step. Then I see people, the Roth IRA is really good for individuals to the extent they want to create income that's not taxable in the future. Roth IRA, currently, they generally have a very low income threshold for who can contribute to a Roth IRA, but don't get too worried. So far, so good. But another, what I would say, loophole in the tax code is that you could contribute to an IRA, and they essentially allow you to convert that IRA, no matter your income threshold, to a Roth IRA. Which means you're converting. So that becomes a little bit more complicated, but don't just look at the Roth IRA and say, oh, I'm outside of that income limit. I can't play in
Just
that
to
sandbox.
simplify it, so in case that you cannot put any money in Roth IRA, just put it in IRA, and then later you can switch that to be a Roth IRA.
Yes. Yeah.
Okay.
So especially in financial purposes, when you're looking at your payouts when you're retired, I don't want all of my retirement income taxed, right? I only want a portion, and that comes through that planning. I would say that's a tax law that currently exists. People have been trying to say that loophole needs to be closed. I don't know where that will go. I haven't heard of that for the current tax reform. But I also didn't think carried interest was on the table, but Trump said something 3 days ago about it. So I don't know. But I would say right now for the 2024 taxable year, and I would even anticipate for the 2025 taxable year, we're under the law that exists right now. And then the last one you asked about was the IRA, which is really nice because I have to have the cash to contribute to the IRA, but that IRA will give me an immediate deduction on my tax return. So that's a way to say if I have to, it's not a dollar for dollar reduction, meaning if I put 2,000 into an IRA, I'm not going to lessen my tax by 2,000. But you might say I'd rather lower my federal tax and put it into the IRA, because then all that growth going into the future, right, is set aside until you withdraw on it. So those are three basic ones, and I'd say they can be really confusing to people. But I think it's worth evaluating, even if you have kids and you just put $100 in on behalf of them. Like by the time they actually use that when they're 30 or 40, it's significant. I know not everybody has $100 to do that with, but something worth to explore.
This is great. Thank you very much. So, I'm gonna ask the audience if they have any additional questions or something that you want to add to Lynn plate. Please feel
Yeah.
free to open your mic, ask your questions, or you can write it down in the chat. Um, but then,
Yeah.
as people are, go ahead.
The last thing I was just going to say, people said tax reform. We're pretty comfortable that it's not going to happen in the first 4 months. There's this thing called budget reconciliation that has to go through, and for whatever reason, the Senate is controlling that process. There's lots of reasons, but we don't get into it. And they really want to focus on other initiatives in their first budget reconciliation. We are expecting it to see in the second budget reconciliation. But I'm a little bit, I guess my one thing to all of you is don't assume that tax reform is happening because we had a Republican sweep within the House, the Senate, and the presidency. The House margin is very, very small. And it will not surprise me at all. And they've even had indicators that they're going to have to reach across the aisle to be able to pass anything because they already have about 30 or 40 people in the Republican Party in the Freedom Caucus that don't want to support what the Republican Party is preaching right now. So, anyways, I would say stay your course. Do as the law exists as 2024. They can't come back into 2024. For 2025, it might be a different story. But normally, what we find if they're causing an internal revenue code to penalize someone, they wouldn't do it retrospectively. They'd only do it prospectively. But again, this is a different type of administration, so I don't like to, sell my hat on that. But definitely monitor that more so for your 2025 tax planning. 2024, the law is set; it should not change.
All right, so I'm gonna wrap up this. Given that people just thanking you here, I'm gonna ask you last question. Hopefully, that will be the concluding one. Uh, uh, there are all people here in the U.S. who live in the U.S. and they are naturalized and becoming a U.S. citizen, and they sometimes in their future they're moving outside of the U.S. So at that time, we need to think about the foreign earned income. What
Yeah.
exactly has that to be to deal with the tax inside of the U.S. So I know there's some rules related to how much you can deduct and how much exactly need to be reported and stuff like that. But can you go like in maybe maximum
That
2 minutes?
might be
I don't want
deeper
to take
than
your
I
time.
know, Mohammed, but I will say in general, once you're a US citizen, at least my understanding, because I did live abroad and we did have people who chose to renounce their citizenship. One of the primary reasons was taxes. So once you're a US citizen, the US kind of says we get to on everything worldwide, no matter where you live. And I would anticipate, I know at least born U.S. citizens. I can't speak to if they became naturalized. They have to renounce their citizenship to stop paying taxes in the U.S. But there are different mechanisms around the different countries that you would be in that ideally, again, would have that same concept that $1 of taxable income isn't taxed twice in the U.S. or a foreign country. Yep.
Lynn, as usual, this is very, very helpful. When I thought about this session, I thought that the best person can talk about it is IRS because I remember the first day in my class, I was teaching something and you just saw IRS on my slides and you jump into my room asking question about IRS. What are you teaching about the
What are you
IRS?
doing? Does someone else care? I know. No, it's a
So
painful time of year right now, but yeah, definitely hear any additional questions or if the links don't work or feel free to reach out to me on LinkedIn or I gave my email address or Mohammed. If you don't hear from me, ask Mohammed. He'll make sure I answer. So
I appreciate that very much. And we are going to post the link for these slides as well as, if you don't mind, for sure, Lynn, in addition to the recording on our website, and will be available for you guys to try to look at it at your own time. And Lynn information is already available. I encourage you to follow her in LinkedIn. She has been an amazing person to see talking about taxes. It makes you interested in the topic even if you're not really interested into it. So thank you very much for your time, and I appreciate everybody here. We hope to see you in future, webinars.
yep. Thank you
All right.
guys. Take care. I'm just going to answer one question in the chat and then I'll pop
Sure,
out.
please.
Okay. Okay. Okay, thanks guys. Have a great night.
Thank you, then.
Take care. Bye.
Bye.